Wall Street has a swap so exotic that its own notional principal can disappear before the contract even ends. And it was built specifically to fight one of the most unpredictable forces in fixed income. We're talking about indexed amortizing rate swaps, and if you've ever wondered how banks hedge mortgage-backed securities, this is the instrument at the center of that story. So here's the question. What is an indexed amortizing rate swap, also called an IAR swap? Is it option A, a swap that automatically resets its fixed rate every year to match the current market? Or if it is option B, a swap where the notional principal shrinks or grows according to changes in a floating rate index and is used specifically to hedge prepayment risk? Take a second. What would you say? The answer is option B. An IAR swap is a structure where the notional principal itself is not fixed. It moves based on where a floating rate index goes. And that movement is designed to mirror what happens to the underlying assets being hedged. Now let me really break this down because the mechanics here are genuinely fascinating and the logic is tighter than it first appears. Start with the problem this instrument was created to solve. Imagine you're a bank or an asset manager holding a portfolio of mortgage-backed securities. The cash flows you receive from that portfolio depend on homeowners making their monthly payments, but homeowners have the right to prepay their mortgages early. They refinance, they sell their homes, they pay off the loan ahead of schedule. And the single biggest driver of when they do that is interest rates. When rates fall, prepayments explode. Homeowners rush to refinance into cheaper loans, and suddenly the mortgage-backed securities you're holding are returning your principal much faster than you expected. When rates rise, prepayments slow down dramatically because nobody wants to give up their cheap fixed-rate mortgage. This creates a massive hedging problem. You can't just go out and buy a plain vanilla interest rate swap because a standard swap has a fixed notional that sits there unchanged for the entire life of the contract. If your underlying asset is shrinking at a rate that depends on where SOFR is, a fixed notional swap is going to leave you overhedged or underhedged constantly. It's like trying to hedge a moving target with a stationary shield. So the IAR swap was engineered to solve exactly this mismatch. In an indexed amortizing swap, the two counterparties still exchange fixed and floating payments. That part is the same as any interest rate swap. But the amount those payments are calculated on, the notional principal, is not fixed. It's tied to a reference index, typically a short-term floating rate like SOFR. And the way it amortizes is structured in advance using a schedule that the two parties agree on at inception. Here's how the logic flows. When rates fall, the index drops, and the amortization schedule says the notional principal should decrease quickly. That mirrors what's happening to your mortgage portfolio. Prepayments are accelerating, and your principal balance is shrinking fast. When rates rise, the amortization slows down, meaning the notional stays larger for longer. Again, that mirrors reality, because prepayments are slowing and your mortgage portfolio is holding on to its principal balance longer than expected. Let me give you a concrete example to make this tangible. Say you're holding $100 million of mortgage-backed securities, and you enter into an IAR swap with a 2-year lockout period and a maximum life of 5 years. For the first 2 years, no amortization occurs. The notional stays at $100 million. After that lockout, the amortization kicks in based on where SOFR is relative to a strike rate, say 4%. If SOFR is at 3% hours below the strike, the notional might drop by 30% of the remaining balance each quarter because low rates mean heavy prepayments. If SOFR is at 5% above the strike, the notional might barely move, dropping maybe 5% per quarter because high rates mean slow prepayments. The exact schedule is negotiated and locked in at trade date, but it's built to track what a mortgage pool would actually do under those rate scenarios. The result is a swap whose notional life closely mirrors the expected duration of your mortgage assets across different rate environments. When your hedge object shrinks fast, your hedge shrinks with it. When your hedge object holds its balance, your hedge holds too. That's what makes it a natural hedge for prepayment risk. It doesn't just hedge the rate exposure, it hedges the structural uncertainty about when your principal comes back. Now there's a cost to this elegance. IAR swaps are path dependent. The notional at any future point depends not just on where rates are today, but on the entire history of where rates have been. This makes them significantly harder to value than standard swaps. You can't price them with a simple discount curve. You need a full interest rate model that can simulate thousands of rate paths and calculate expected amortization along each one. That makes them an instrument for sophisticated counterparties in structured finance desks at major banks, and it's exactly the kind of product that requires deep quantitative modeling to manage properly. But the underlying intuition is clean and powerful. You have an asset whose duration and cash flows are uncertain because of optionality embedded in the underlying loans. You build a hedge that has the same kind of optionality baked into its structure, so the two move together. That's structured hedging done right. IAR swaps exist because plain vanilla tools can't handle prepayment risk. When your asset's duration changes with rates, your hedge has to change with rates too.